So one of the things I've liked about this company is the ability to innovate in its category to deliver better return on ad spending for its customers. Since launching one of its newest innovations, which they're calling Coquet, this new service has delivered on average 26% better cost per acquisition, 58% better cost per unique reach, and a 94% better click-through rate compared to their previous generation product they called Solimar. And so these kinds of innovations improve the return on advertising spending, which brings customers back to the trade desk and increases the budgets they allocate to purchases via the trade desk. And so this is a competitive advantage for the trade desk, not just this particular program or product that they launched, but their continuous ability to innovate and serve their customers to improve their return on ad spend. That's what really brings marketers to the table, is if you can deliver a return on ad spending that's above their cost requirements, that's above their threshold for what they need in terms of the return in order to justify the spend. And if you can deliver above that, they'll continue allocating their budget. They'll increase their advertising budget, especially if you're helping them generate more sales. That increases their revenue. And many companies have their advertising set as a percentage of their revenue. So those are some positive developments for the trade desk. I know a lot of the discussion surrounding the trade desk has been Amazon's decision to launch its own competing service and the trade desk changes at the leadership positions and the company's significant stock-based compensation. A lot of negative sentiment surrounding the stock. That's some of the reason why it's down 66% year to date in 2025. But given the recent stock price sell-off this year, it's been one of only a few times. In fact, this is the first time in 2025 where I rated the trade desk stock as a buy starting in April when it dipped around $50 per share is when I initiated a buy rating on the trade desk, which is the first time since I started following the company that I rated the company as a buy. And I also bought shares from my own portfolio. So I do see this as a buying opportunity. It comes with greater risk, to be sure, but it's trading near its 52-week low at for $38. The intrinsic value per share, or the fair value I calculated, is $65. And when I look at the market multiple valuations, they also look ridiculously cheap at a forward PE of 20 and 17.
Click the link below to watch the full video.